Welcome back to Red's Roundup. In this video, we're going to be looking at Spac Arbitrage, an exciting new opportunity. So, some of the info on Spac Arbitrage. So, we're in a 0% interest rate world. If you can find a way to make above the risk-free rate in a pretty safe way, in 2 years or less, say, as a cash equivalent, with low downside and higher upside potential in a pretty simple situation, that's something I think a lot of people are going to be interested in. And so the details of Spac arbitrage is a SPAC. I'm assuming you know what a SPAC is if you're watching this video. A SPAC is listed, and then it IPOs, and IPO investors buy in at trust value, and then they hold that cash in a trust account. So that trust account is not held by the company; it's held by uh, uh, a bank, say like Wells Fargo or Bank of America or something like that. They hold it in trust account in less than 180-day government bonds. So government guaranteed bonds, those are a risk-free investment. That's what's held in trust. And so what happens is in between the time the SPAC IPOs and they find a target company, which can be up to 2 years, 24 months, what happens is there's volatility in the price of the SPAC, and that the price of the SPAC, the shares, the common shares, or the units, which we'll get into later, can dip below the value of the trust account. And so when that happens, you can buy and you get the risk-free yield on the government bond and the yield of the difference between trust value and what you bought it for. And you might be thinking, well, wait here. What if they go out and do a bad transaction that you don't like? Here's the kicker. Whenever they do a transaction that needs to be approved by the shareholders, you can automatically say, I don't like this, and you can get all of your money back from the trust account. So you go from put money in, they make a deal, they go to you, say, can we do this deal? You say, no, I don't want to do that. I want my money out of trust. So that's pretty good. And then you don't even need to worry about this part of it unless what happens is the price of the SPAC jumps way up when they announce a deal, in which case you will sell at the higher price and you won't redeem. So step one is essentially to go to spactrack.net, the best site I've found for a list of all SPACs and some of their important statistics, and just understand the basics of SPACs and the current environment surrounding SPACs and what they're selling for, what their deal structures are, what their warrant terms are, all those things. Filter by less than IPO price and searching for a company, searching for a target, and we'll go through all this at the end of the video, and model the return profile for various SPACs. So different SPACs, they'll have different structures, or not very many have different structures, but different time frames to be completed, different prices, and you'll want to just model that out and see what it turns out to, and find the best return profile, and then do more due diligence, and then buy. And then after you've bought, set an exit plan. Make sure you know when and where you're going to exit. Are you going to just hold it until the transaction is announced and hope for a bounce in the price? Are you going to hold it until the SPAC sells for over $10 a share? Either one of those have very different management. So if you're going to hold it for until the transaction is announced, you're going to want to stay up to date on the news on their transactions, like I have here. If you're going to just sell at $10, you're going to want to stay up to date on that. But most importantly, you're going to want to set a limit order, a limit sell, to sell at $10. Okay, and then that's all for here, and we're going to check out just this quick step-by-step process. So here I am at spactrack.net, my preferred source for free SPAC information. I think there are some paid services, but I don't use those. And so this is the screener page. You just go up here, click active SPACs. If you want to do other research, you can do that there. And then you can do some screening here, filtering, and then you can sort. So by trust value, market cap, price of commons, price of units. Those are the main ones. Also, another one I like to look at is progress to deadline. So the closer to the deadline, the quicker you're going to get your money back. So it increases your annualized rate of return. And then you can sort it. So you could say percent change of last day. Yada, you get it. You get the point here. So step one, just familiarize yourself with this. Next, we're going to sort by searching and under IPO price there. And you can see there's a good amount found. So you're going to have to look through and find some ones that you like. A portion of this too is going to be you understanding which one of these have the chance to bounce on the upside if they announce a good deal. So if you find someone that you think is a good sponsor, you might want to buy one of those. And so here's another thing to keep aware of, the number of warrants per unit. That can be very important. If you are buying units, you want to buy the right number. You don't want to buy the wrong number. Let's say you buy 4 units and it's 1/5 of the unit per, or 1/5 of a warrant per unit. You're not going to get a whole warrant, and that would not be good. Okay, so here we have it sorted by searching and trading under IPO price. That means they're looking for a target and it's trading under the IPO price, and that will be under the trust value too. So just you can start by price of commons. Okay, so here's one, BRIV Spac trading for $9.60. Okay, we found one. Let's go ahead and model that out. So here's a very basic Spac arbitrage modeling spreadsheet. You just put in your purchase price. Let's zoom in a little bit. You just put in your purchase price. You put in the end date for the SPAC, and then you put in the annualized return. And this is assuming no return from the government bond that they will hold, which is about the case because we are in a pretty much zero interest rate world. And so, like for this one I already modeled out, it will return 2.33% over the SPAC's lifetime. And so that's pretty good for a government bond, less than 2 years, government bond equivalent. Now, that isn't to say there won't be volatility in the interim, but those things are to be expected because it really is just about the end point, where you buy and where you sell. So yeah, that 2.33% return is pretty good if you're looking for a cash equivalent. And that doesn't take into consideration the potential upside if they do announce a good target and say you can sell at 12. Because say you sell at 12, that gives you a 13% annualized return. So if something like that happens, you can make a lot. And that brings us, so then you would buy the SPAC, and then you would set up your exit strategy if you're going to hold till expiration, or not expiration, till the deal is announced, or if you're going to just sell at $10. Either one, you're going to want to keep track of the news, make sure you don't miss any redemptions. And so the other strategy here that I like, it's a little bit of a more complicated one. It's a little harder to model, but you still make money. And I'm suspicious that you might even make more money. So let's just look here, trading under IPO price, searching, and we're going to want to go for recent IPO. Actually, no. We're going to go for pre-unit split. And then we're going to have a number of options listed here. And we're going to see you only get the unit price. And so you're going to want to filter for low unit price. And you're going to find some that it's not going to be as big of a discount. And the time until expiration is going to be very far. That being said, if you can purchase some units for a very low price, you not only get shares, you get the commons, but you also get warrants. So let's say I bought 3 shares for $9.83. I would get 1 warrant and 3 shares. So that warrant is going to be worth, let's just say, $1. And that's going to bring our value up above 10 even. And you see this, that there are some units that trade above $10. A lot of them don't, but some trade above $10. And even more units as you get closer to expiration trade above $10. So let's just imagine you were to buy this one and it was to go up above the $10 mark, which oftentimes happens, and warrants can make it go up even way more. Let's go not search all of them, and let's just sort by unit price. So there are units selling way above the price of common. So this common is selling at a discount, but the unit is selling above $10. So let's say you were to have bought that unit below $10, sell it for $11, that's a pretty good profit. And usually that happens quicker than this. So there are a couple of different strategies you can implement. This video is basically just an overview as to what those strategies are and that this even exists, because a lot of people don't even know about Spac arbitrage. It's a fairly obscure thing. Most of what they hear when they hear of SPACs is just people stealing your money, which does happen. Not exactly stealing, but just wasting it. You hear about all the crazies like Colin Kaepernick has his own SPAC, and SPACs get a bad name, but really it's just a tool. And if you can add another tool to your investment toolkit, you can become a better investor. That's how I see it. So let's just say you've got these returns instead of government bonds, which are yielding about 0%. Over time, that's going to make a big difference in your portfolio if you can utilize this. So I hope you found this video useful. Let me know if you have any questions, because I know it can be pretty complicated. I have done a lot of research. I would say hours and hours of research on this topic. So I am fairly well versed. The whole name of the game with this is taking as little risk as possible and making a decent profit and enabling the upside. Because like you've heard people like Monish Pabrai, he preaches buying 50-cent dollar bills. Well, how about buying 90-cent government bonds trading for $1? Like it's pretty much the same thing, except less risky in my book. So, yep, I know I rambled a little bit. Thanks for watching. See ya.